Good morning, traders, and welcome to BCR's morning market analysis. Let's take a look at what's driving the major moves across currencies, commodities, and metals. First up, let's have a look at the US dollar index, which slipped sharply before the weekend, falling from a 2-month high of 100.26 to about 98.68, which is a decline of 1.28%. The drop followed signs of a weakening labor market, which increased the likelihood of multiple Fed rate cuts this year. Several FOMC members have voiced support for easing borrowing costs, and markets are now pricing in a more dovish policy path. Adding pressure to the dollar, the US administration began implementing the first round of reciprocal tariffs in early August, targeting the EU, Japan, and South Korea. More hikes are expected next week for countries like Brazil, Switzerland, and India. Meanwhile, Eurozone inflation surprised the upside, strengthening the ECB's hawkish stance and lifting the euro. Caution remains in the air as President Trump's new tariff package, effective from the 1st of August, imposes duties of 10 to 41% on imports from multiple countries, including Canada, India, and Taiwan. Following failed trade talks with these countries. Technically, the dollar index has pulled back to 98.68, holding just above a key support zone between 98.3 and 98. It's still trading above both its short and medium term moving averages. The MACD remains in a bullish expansion phase, while the RSI hovers just above 50, suggesting upward momentum hasn't fully faded. If support holds, upside targets could include 99 and 99.78, the latter aligning with the 100-day moving average. A decisive break above 100 remains the key to confirming a sustained bullish trend. A failure to hold above 98.3 could open the door to deeper losses towards 97.49 and the psychological level of 97. Next up, let's have a look at WTI. WTI crude fell 2.7% on Friday, closing near $67 per barrel. Still, the commodity posted a weekly gain of over 3%, supported by speculation that the OPEC may soon finalize an agreement to raise production. Sources suggest a possible output increase of around 548,000 barrels per day, though the final figure is still under negotiation. Sentiment was also impacted by President Trump's new tariff package set to take effect on the 7th of August, which targets imports from countries including Canada, India, and Taiwan. At the same time, oil prices found some support after Trump threatened to impose a 100% secondary sanction on buyers of Russian crude. That move could disrupt about 2.75 million barrels per day of Russian seaborne exports, especially to China and India. On the chart, WTI has rebounded from last week's low of 64.81 and closed this week with a bullish tone. Prices are currently above the 23.6% Fibonacci retracement level at 66.79. The short-term moving averages have formed a bullish golden cross, and the MACD is expanding above the zero line, both signs of solid upward momentum. Prices are now facing resistance around the psychological $70 level, and last week Wednesday's high of $70.02. A break above the 200-day simple moving average at 67.69 could extend gains towards 68.69 and potentially $70 plus. On the downside, support is seen at 66.27 with a break below that level, opening the way back towards $64.81. Next up, let's have a look at gold. Gold prices surged nearly 2% on Friday, climbing above 33.60. The move is fueled by soft US employment data, which reinforced expectations of a Fed rate cut in September. Only 73,000 jobs were added in July, which was well below forecast, and prior months were also revised downwards. As a result, market pricing for a September cut jumped from 45% to about 75%. That labor data followed a strong PCE inflation report, adding further complexity to the Fed's outlook. President Trump announced a new retaliatory tariff of up to 41% and a 40% penalty on goods suspected of evading tariffs via third world countries. Technically, gold found a base last week around 100-day simple moving average at 32.70. The post FOMC decline now looks to have paused, and oscillators are starting to turn positive. A sustained move above $3,300 could target near-term resistance at 33.73, which is the July 25th high, followed by the psychological level of 3,400 and the 23rd July peak of 34.39. Key support is seen at 33.50 and 3300. A break below this area could lead to a retest of 3268.5. Further downside risk would emerge if that level fails, with the next support zone between 32.48 and 32.47. A drop below that region could trigger a move towards $3,200. Lastly, let's have a look at the Australian dollar, which steadied near 64.60 on Friday, snapping a 6-day losing streak. The rebound came as the US dollar weakened sharply following poor non-farm payrolls report, while Australia also avoided the latest round of US tariff hikes. Despite prior threats, most Australian exports remain under the standard 10% rate. Progress in trade and security talks appears to have helped Australia dodge steeper tariffs, which were raised to about 15 to 41% for other nations. Meanwhile, copper prices closely tied to the Australian dollar plunged more than 18% after the US clarified that refined copper would be excluded from the new tariffs. This, along with the Reserve Bank of Australia's dovish tone, weighed on the Australian dollar's sentiment and contributed to its worst weekly performance since March. Technically, the Australian dollar remains under pressure. The pair is trading around 64.60, 64.70. And stays below the 50-day SMA at 6511, with the 14-day RSI near 45, both pointing to weak momentum. Support lies at the 2-month low of 64.20, with further downside targets at 63.72 and the 150-day SMA at 63.77. A deeper slide would bring the 63-cent level back into focus. Resistance is seen at 65 cents. A break above these could shift the tone and open the way towards 65.76, which is the 76.4% Fibonacci retracement level from 0.6625 to about 6420. Well, that's all for today's morning market analysis. We'll be watching closely as the new week unfolds. We'll see you again later for the evening wrap. As always, manage your risk and happy trading.